FBT, fringe benefits tax change there. I think it was just one area which had some amendments there, and that's in relation to living away from home allowance. So this may not apply to many of your clients, but for those of you who may be in WA where you have clients working in the mines or having to travel a long way for work purposes, employed, then this may apply to you. So this is really a tightening of the living away from home allowance provisions. So at the current time, I think it's fairly loose in terms of the provisions in that someone may not really be travelling away from home to who should have received the benefits there. Pretty much their allowances such as accommodations and cost of being away that are paid without tax and FBT to such employees. Of course, we're agreeing that some of these employees should be provided with allowance and should be provided with the benefits as well, simply because they are away from home and therefore that aligns with the requirement of the employment. But to strengthen up this area, what they are proposing is from 1st of July 2012 for arrangements after budget night, these provisions will apply. And from first, so the tightening of these provisions will apply from 1 July 2012 for arrangements after budget night. So any arrangements that come in after that, these provisions will apply, and 1st of July for those before. The tax concession will only apply to those for a maximum of 12 months. At the current time, obviously, there's no limit to it, but the provisions tighten up to propose that this will only apply for a maximum time of 12 months and no more. And the provision shall only be limited, again, access to those who own home that they're living away from for work. So, for example, if someone has got a main home at the moment and having to travel away for a period of time, and therefore that would comply with these requirements there. You should note as well, though, that the couple of exceptions there, it doesn't impact your clients who are on a fly-in fly-out arrangements, and they're not subject to a 12 months time limit. So those are the ones which will not come under the arrangements, and it also does not affect tax treatment of travel and meal allowance for those employees on pretty much short work periods, about 21 days sort of time frame. So it doesn't apply to everyone, but for those clients who may be impacted, then obviously you need to consider perhaps renegotiating with the employer for perhaps the loss of some of these concessions, and therefore up the remuneration package, for example. So remember, it applies from 1st of July 2012 for those ones after the budget night, but if not, then 1 July 2014 for those before. Okay. And that's pretty much all I want to say about the FBT implication. Not much change there, just one particular point there. Let's have a look at the company tax. Some change in this area, and pretty much you've read quite a bit in the papers before Tuesday night, which sort of leaked out of Canberra. But let's have a look in detail what that means for some of your clients who may operate their business through a company or have investments in a company structure. Remember the case that we are not getting the company tax cut. I guess this is a sort of concession, if you like, but don't forget it applies if we have losses. If we don't have losses, then obviously this doesn't apply. And this is only applying and available to companies and entities that are taxed like companies. Okay, so that's the first point that you need to appreciate. And from 1st of July 2012, so 2012-13 year, losses will be available to carry back 1 year. So that means if you have losses in 2012-13, then it's available to offset against this current year, 2011-12 profits. But from there on, from 2013-14 and later years, the provisions will allow your clients and company to carry back 2 years instead of 1 year. The losses that can be carried back, only revenue losses. So that means perhaps not capital losses, or losses as a result of a disposal of a capital asset. So revenue losses only, and it's only limited to $1 million of losses per year. So remember, $1 million losses per year is gross, and with a company tax rate of 30%, then it's equivalent to a maximum of $300,000 cash refund. The other overriding requirements is that despite the fact that you could have losses, it is limited to the company's franking account balance. So we will need to manage the franking account balance pretty well there. Okay, let's look at the considerations and the impacts. As I said, this is pretty much in lieu of the no company tax cut. But then again, if we have no losses, then it's not much use to us. But if in the case of where we do have losses, we could carry back a year or 2 years, from 1st of July 2013 onwards. It does provide an additional source of cash flow, I guess, in a loss situation. Better than nothing, I guess, and some companies may have quite a huge amount of losses that we could utilize in this way. Rather than having to wait for a profit in the future, we could certainly move back to if we did have a profit in the year and years before, 2 years at least. Now, my only concern here is, and I said up front that it applies to companies and entities that are tax-like companies, so that probably means that other structures such as partnership and trusts, we're not, we don't have that luxury to do that. So at the current time, without further details and without looking at the legislation, then we're saying that the losses are only available to companies. So if your client's a sole trader, unfortunately, we might miss out on that, and as a partnership or trust. So we will wait for details to certainly confirm that. Now, the last point I mentioned on the slide was that the last point on the slide, which I mentioned previously, was the limitation with the company's franking account balance. Remember, franking account balance is really to record when a company makes a profit and therefore pay over 30% tax that we have a franking account. And when we pay off dividends where we frank the dividends, then that reduces the franking account. It's really capturing the amount of tax we pay and then to flow on to dividends, frank dividends, if that was the case. So if we are limited by not just the losses but the balance of the franking account, then that means we have to consider and manage dividend policy if we're thinking about claiming the losses, because we are subject to the level of franking account balance as well too. So therefore, if we were to pay a dividends with a franked amount, then that means that would be reduced, and that would limit the amount that we could offset, obviously subject to the $1 million losses per year. That would limit it as well. So it's a matter of really working through if we're going to use the loss provision, and then to look at how much losses we have, and then to overlay that with the franking account level that we have to work out how much tax that we're able to recoup from these losses carry back. So that's pretty much all I need to say about company tax in terms of the losses. Let's move on to the area of CGT and capital gains tax. A couple of changes there, fairly minor. I'm glad to report there. In fact, it was sort of leading on from the previous budget and previous year's announcements. The first one, again, is just changes to make sure that the beneficial interests are recognized, changing consistency, making sure that the various CGT provisions interact and work properly in the areas such as scrip-to-scrip rollovers and also the small business concessions in trusts. With beneficial interests, this sort of trying to correct it to make sure that it sort of flows through and operate well together. The only other point is the exemption for compensation payments and insurance policies. Again, this is where it's paid into indirectly through a trust, just making sure that there's no difference between the two.